Most people only think about taxes once a year, and that's exactly when they overpay. But starting January 1st, 2026, some of the biggest tax rule changes we've seen in years are kicking in. And if you're not ready, you could miss out on thousands of dollars in legal tax breaks. A big reason this is happening is that a lot of the rules from the Tax Cuts and Jobs Act of 2017 are scheduled to expire after the 2025 tax year. At the same time, the IRS has already started publishing updated limits and thresholds for 2026, which will affect how much you can save for retirement, how big your deductions are, and what credits you qualify for, whether you're an employee, a parent, a small business owner, or a retiree. So in this video, I'm going to walk you through 7 key tax changes you absolutely need to know about. In plain English, no jargon, no CPA talk, just clear, straightforward guidance so you can protect your wallet and keep more of your money working for you in 2026 and beyond. All right, let's start with the good news. In 2026, you're allowed to put more money into your retirement accounts. According to IRS Notice 2024-75 and Section 415 of the tax code, the employee contribution limit for employer plans like 401k, 401k, 403b, 457 plans, and the federal thrift savings plan will go up to $24,500 in 2026. That's an increase from $23,500 in 2025. On top of that, there's also a maximum on the total that can go in when you add together what you put in and what your employer puts in. That overall cap is rising to $72,000. So if you get a match or profit sharing from your company, that extra room really matters. If you're age 50 or older, you also get what's called a catch-up contribution. Think of it as a bonus lane to help you top off your retirement savings. In 2026, that catch-up limit is increasing from $7,500 to $8,000. That's real money that can compound for you over the next 10, 20, or 30 years. Now, there's a special rule here for higher income earners. Under the Secure Act 2.0, Section 603, if your income is above a certain threshold, all of your catch-up contributions starting in 2026 will have to be made as Roth. In plain English, that means you pay the tax now, but the growth and withdrawals in retirement can be tax-free as long as you follow the Roth rules. For a lot of people, especially younger high earners, that's not a punishment. That's actually a huge opportunity. Here's why all of this matters. The government is basically giving you a bigger bucket to save for your future. But they're not going to fill it for you. If you keep your payroll deferral percentage the same as last year, say you've been doing 10% forever, you might not hit these new higher limits. So sometime before January 2026, log into your HR portal or talk to your payroll department. Check how much you're actually set to contribute and adjust that percentage so you're using as much of these new limits as your budget can comfortably handle. Future, you will be very glad you did. Now let's talk about IRAs. Because these accounts are getting a boost too, and this affects millions of everyday Americans who save outside their employer plans. According to IRS Notice 2024-75, the annual contribution limit for both traditional and Roth IRAs will rise to $7,500 in 2026. That means every adult with earned income can put a little more into these tax-advantaged accounts, whether they prefer the upfront deduction of a traditional IRA or the tax-free growth of a Roth IRA. And here's an interesting twist. For Americans age 50 and older, the IRS is increasing the IRA catch-up contribution to $1,100. Now, if that number sounds strange, you're not imagining it. Historically, IRA catch-ups have gone up in clean $500 steps. This is the first time we've ever seen it move by just $100. It's unusual. And it's a reminder that the IRS is adjusting these limits more closely to inflation formulas rather than round, easy-to-remember numbers. But here's the bottom line. More room means more opportunity. Even an extra few $100s a year consistently invested can turn into tens of thousands over your retirement timeline. Think of this as the IRS saying, yes, inflation is real, But let's not make your retirement any harder than it needs to be. If IRAs are part of your saving strategy, make sure you update your automatic contributions before 2026 so you don't miss the new limit.
Now let's move over to health savings accounts, or HSAs, because these are changing too. And honestly, if you qualify for one, this might be the single most powerful account in your entire financial life. According to IRS Revenue Procedure 2024-28, the contribution limits for 2026 are going up again. For individual coverage, you'll be able to put in $4,400. For family coverage, the limit will be $8,750. And if you're age 55 or older, you can still add an extra $1,000 as a catch-up contribution on top of those numbers. You might notice something a little weird here. The family limit used to be basically double the individual limit. That made it easy to remember. Now, thanks to the way the IRS calculates inflation adjustments, the numbers don't line up as cleanly. So instead of just twice as much, we're dealing with $4,400 and $8,750. Not pretty, but that's the reality. So why should you care about an HSA at all? If you're in a high-deductible health plan, and that's key, you have to be in an HSA-eligible plan. This is arguably the most tax-efficient account in America. It has what we call a triple tax advantage. Your contributions can be tax-deductible or made pre-tax through payroll. The money inside the account can grow tax-deferred. No tax on interest, dividends, or gains along the way. And if you use the money for qualified medical expenses, your withdrawals are tax-free. Deductible going in, tax-free coming out, and tax-deferred in the middle, there's really nothing else like it. With healthcare costs rising and deductibles getting higher, being able to stash more into an HSA in 2026 gives you extra room to soften those blows. So if you are already in a high-deductible plan, now is the time to check your contributions and make a plan to take advantage of these higher limits. Now let's talk about something that affects almost every household in America: the standard deduction. This is one of the simplest parts of your tax return, but it has a huge impact on how much of your income is actually taxed. According to the IRS's official inflation adjustments published in the Federal Register, the standard deduction is going up again for the 2026 tax year. Here are the new numbers. If you file as single, your standard deduction will be $16,100. If you're married, filing jointly, it jumps to $32,200. And if you qualify as head of household, your deduction will be $24,150. Now, why does this matter so much? Because about 80% of Americans take the standard deduction instead of itemizing. That means, for most people, this is the one number that directly reduces the income the IRS can tax. A higher standard deduction simply means you pay taxes on less income, without having to track receipts, without itemizing, and without changing anything about your lifestyle. It's automatic. So whether you're a young worker filing single, a married couple trying to stretch your dollars, or a parent filing head of household, this increase gives you a little more breathing room on your tax bill for 2026. And in a world where everything seems to cost more each year, any reduction in taxable income is a win. Now let's get into one of the biggest headlines for taxpayers living in high-tax states: the expansion of the SALT deduction, which stands for state and local taxes. This change alone could shift the entire tax strategy for millions of Americans. Since 2018, the SALT deduction has been capped at $10,000. That cap applied whether you were single, married, or filing head of household. It didn't matter. For people living in states like California, New York, New Jersey, and Illinois, where property taxes and state income taxes easily exceed $10,000, this cap has been a major pain point. But according to recent legislative updates that will be reflected in the IRS's upcoming revision of Publication 501, that cap is getting a massive temporary increase. From 2025 through 2028, the SALT deduction limit jumps to $40,000. For homeowners and high earners in high-tax states, this is huge. Finally, you're able to deduct much more of what you actually pay in property taxes and state income taxes, something many taxpayers have been asking for ever since the original cap was introduced. And here's where it gets even more interesting. This change means a lot more people will start itemizing their deductions again, instead of taking the standard deduction. Once you itemize, that opens the door to additional deductions, things like medical expenses, charitable contributions, and certain miscellaneous write-offs that only count if you itemize. So if you live in a high-tax state, or you own property with significant taxes, the SALT expansion could reduce your taxable income dramatically. It's a big win, but only if you understand how to leverage it. And that starts with knowing your numbers and planning ahead for the 2026 tax year. Now let's talk about one of the most important sets of changes for families, the updates to the Child Tax Credit and the Child and Dependent Care Credit. If you're a parent in the U.S., this part really matters. Under the IRS guidelines for the Child Tax Credit, based on Publication 972 and the way the TCJA rules phase out, the credit is being permanently increased to $2,200 per qualifying child, starting in 2025. Then, beginning in 2026, that $2,200 won't stay flat. It will be adjusted each year for inflation. In plain English, that means the value of your credit is designed to keep up, at least somewhat, with the rising cost of living. You still have to meet the normal rules. Your child has to be under a certain age, have a valid Social Security number, live with you most of the year, and your income has to be under certain thresholds. But for families that qualify, this credit directly reduces your tax bill, dollar for dollar. Now, alongside that, we also have a big improvement to the Child and Dependent Care Credit, starting in 2026. This is a totally separate benefit from the basic child tax credit. This one is tied specifically to what you spend on care so that you can work or go to school. From 2026 onward, eligible parents can receive a credit of up to 50% of qualifying childcare expenses. The maximum expenses the credit can apply to are up to $3,000 of expenses if you have one child, and up to $6,000 of expenses if you have two or more children. So if you're a working parent paying for daycare, after-school programs, or summer care so you can hold a job or pursue your education, this credit helps offset those costs. Think of it this way. The child tax credit helps you simply for having kids and meeting the rules. The Child and Dependent Care Credit helps you for paying someone to watch those kids so you can earn a living or finish school. This whole package is designed for working parents. If childcare is what allows you to show up at work or sit in a classroom, the IRS is effectively saying, we'll help cover part of that bill. And if you understand how to claim both correctly, it can make a meaningful difference in your refund or in how much you owe at tax time. Now here's a small but really thoughtful change for people who like to give, a new above-the-line charitable deduction. Based on draft changes to IRS Form 1040, even if you take the standard deduction, you'll still be able to deduct a limited amount of charitable giving starting in 2026. The proposed amounts are $1,000 if you file as single, and $2,000 if you're married filing jointly. Why is that a big deal? Normally, to get a tax break for your donations, you have to itemize your deductions on Schedule A. But as we talked about earlier, roughly 80% of Americans don't itemize. They just take the standard deduction and lose out on any extra benefit from their giving. This new above-the-line deduction changes that. It means that generous Americans who don't itemize can still get a tax benefit for supporting charities, churches, and nonprofits. So if you're someone who gives regularly, this lets you do what you're already doing, helping others, and still get a little bit of financial recognition for it when tax time comes around. Now, before we wrap up, let's go over a few other notable tax changes that may not grab headlines but absolutely matter for millions of Americans. First, we have overtime and tips tax relief, available from 2025 through 2028. Under the new rules, workers can deduct up to $25,000 in qualified overtime pay and tips if they file married filing jointly. with lower limits for single filers. This is a meaningful benefit for service workers, restaurant workers, and anyone whose income depends heavily on tips or hourly overtime. For many households, this is real money back in your pocket. Next, there's a new car loan interest deduction, but with a twist. You can deduct up to $10,000 in interest paid on a personal use vehicle, but only if the car was assembled in the United States. The IRS is expected to release a formal list of eligible vehicles, so don't rush out and buy something based solely on this rule. But if you were already planning a purchase, this deduction could work in your favor. And finally, there are important updates coming for student loan repayment plans. By July 1st, 2028, some existing repayment structures will phase out entirely. Borrowers will need to transition into new IRS-approved repayment options. If you have federal student loans, this is something to keep a close eye on. Your monthly payment, interest treatment, and long-term repayment strategy may all change depending on which plan you move into. So while these updates may feel more niche compared to the big tax bracket or deduction changes, they're still part of the evolving tax landscape. And for the people who qualify, they can make a meaningful financial difference.